Is the commercial real estate market truly resilient in the face of rising economic challenges and high interest rates? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Despite the challenging economic landscape and elevated interest rates, commercial real estate investment activities are experiencing an uptick. This trend is particularly notable as investors navigate the complexities of the current market environment. According to a report by Ashley Fahey from the Business Journals, the persistent economic uncertainties have not deterred deal-making in the commercial real estate sector. Focusing on multifamily properties and tenant leasing, the Ontario regions of Kitchener, Waterloo, and Cambridge are seeing a steady demand. Multifamily properties continue to attract investors, driven by the need for housing solutions in growing urban areas. Meanwhile, in the United States, similar patterns are observed in cities like Austin and Raleigh, where multifamily developments are thriving despite economic pressures. Industrial sectors are also holding strong, with logistics and warehousing spaces being in high demand. In Ontario, the industrial market remains robust, reflecting a broader trend seen across North American markets. This resilience is evident in places like Dallas and Chicago, where industrial properties are a key focus for investors looking to capitalize on e-commerce growth. Office spaces, however, continue to face challenges with high vacancy rates. The report highlights that the national office vacancy rate has hit another record high, underscoring the ongoing struggles within the office sector. In Ontario, cities like London are witnessing similar trends, as businesses reassess their need for office space in a post-pandemic world. Retail and other commercial sectors are gradually finding their footing, albeit at a slower pace. Retail spaces in Ontario are adapting by integrating more experiential and service-oriented offerings to attract foot traffic. This mirrors the efforts seen in American cities such as Miami and Los Angeles, where retail innovation is key to revitalizing commercial spaces. Morgan Stanley is making significant strides in the mid-market commercial real estate sector in Australia. According to Andrea Zander from Financial Review, the financial giant is backing a new $500 million Australian dollar lending facility known as Palace Funding Trust No. 5, led by non-bank lender Palace Capital. This initiative is set to provide loans ranging from 15 million Australian dollars to 35 million Australian dollars for various projects, including pre-development, residual stock, and investment properties. As the majority funding partner, Morgan Stanley is teaming up with Palace Capital's family office and high-net-worth investors to fuel this endeavor. The move comes on the heels of Palace Capital's impressive completion of nearly 3 billion Australian dollars in transactions for fiscal year 2025. Notable deals include a 25 million Australian dollar loan in South Yarra and a 45 million Australian dollar construction loan in Sydney, showcasing the firm's robust activity in the market. Florida's commercial real estate finance market gained meaningful traction in the second quarter of 2025, aligning with a broader national recovery in deal volume and capital deployment. According to Paul Blumner from CityBiz, United States commercial and multifamily originations rose roughly 30% year-over-year in the second quarter, with Florida keeping pace as investor appetite focused on multifamily, industrial, hospitality, and selective retail assets. Capital flows remained cautious around office properties, though life insurers and private lenders filled financing gaps on higher quality buildings. Multifamily fundamentals held steady in the second quarter, despite pockets of oversupply in metros like Miami and Tampa putting downward pressure on rents. Florida-wide, cap rates averaged 5.5%, slightly above the 5.2% national benchmark. Statewide, the median rent was $2,090, with a vacancy rate of 6.9%, up from 5.8% a year ago. In Miami, the median rent was approximately $3,000, down 6.2% year-over-year, with a vacancy rate of 7.8%. Tampa saw rents around $2,100, off by 5.0%, with a vacancy rate of 6.5%. Meanwhile, Orlando's rent was around $2,000, down 4.3%, with a vacancy rate of 6.2%. Banks, agencies, and life companies continue to show strong interest in multifamily loans, with standard deal terms including loan-to-values of 60 to 65%, debt yields in the 9 to 10% range, and spreads of 145 to 160 basis points. Lower leverage and stronger in-place cash flow commanded even tighter pricing. Florida's office market, particularly in urban cores, continued to struggle with soft leasing and elevated vacancies. Miami saw second quarter sale volume reach $99.5 million across 39 transactions, with pricing near $162 per square foot. Vacancy inched up to 14.6%, and asking rents averaged $63 per square foot. Orlando showed more resilience in Class B leasing, which represented 74% of new activity, with asking rents ticking up to $27.87 per square foot. However, net absorption remained flat, despite a sub-3.5% unemployment rate. Cap rates in core Florida office markets hovered between 6.8 and 7.2%, above the national average of 6.5%. Financing remained constrained, with loan-to-values capped at 50 to 60%, spreads ranging from 180 to 250 basis points, and terms being shorter. CMBS and private lenders filled some of the void left by traditional banks, while life insurers remained selective but active on top-tier assets. Industrial assets remain the preferred target for both borrowers and lenders. Cap rates compressed to around 5.4% in South Florida, down from 5.8% a year ago, and averaged roughly 5.6% in secondary markets. Logistics hubs across the state continue to post low vacancies, supporting strong lender interest. Many deals are targeting long-held assets with below-market rents, aiming for mark-to-market upside. Typical deal terms include loan-to-values of 60 to 65%, sometimes higher, and debt yields of 10 to 11%. Lender appetite in the industrial segment remains the strongest across Florida's commercial real estate. Retail cap rates stabilized between 6.0 and 6.5% in top tourist corridors, and 6.8 to 7.0% for regional strips. Financing remained accessible, though underwriting tightened for assets outside major metros. Hospitality performance rebounded further in the second quarter, with occupancy and RevPAR approaching record levels in Miami, Orlando, and Tampa. Cap rates ranged from 6.5 to 7.0% for high-end hotels and 7.5 to 8.5% for limited-service assets. Still, rising insurance premiums and escalating construction costs continue to weigh on the sector's lending economics. Conservative underwriting is the rule, not the exception. National versus Florida commercial real estate benchmarks for the second quarter of 2025 show that multifamily and industrial remain Florida's most financeable sectors, backed by strong rent fundamentals and widespread lender interest. The office sector will continue to face value compression, especially in central business district locations. Conversions and repositioning strategies will play a larger role, while underwriting remains cautious. Retail and hospitality present case-by-case opportunities, with prime assets in South Florida and Orlando tourism corridors attracting capital, while secondary locations face more scrutiny. Regional variation matters, as Miami battles rent softness and elevated vacancy. Metros like Jacksonville and Cape Coral are quietly delivering yield stability and cap rate compression, offering an appealing alternative to overheated markets. S2 Capital, a Dallas-based real estate firm, is set to expand its reach in the industrial sector with a significant acquisition. The company plans to purchase Fort Worth-based Fort Capital, a real estate firm with an impressive portfolio spanning 11 million square feet across 3 states. According to Seth Bodine from the Dallas Business Journal, this move marks a strategic shift for S2 Capital, which has been primarily recognized for its expertise in multifamily properties. The acquisition is expected to enhance S2 Capital's operational capacity and diversify its portfolio, tapping into the growing industrial real estate market. This development highlights the increasing interest in industrial real estate, particularly in the context of e-commerce growth and supply chain demands. The acquisition by S2 Capital reflects a broader trend where real estate firms are seeking to diversify their portfolios by investing in industrial assets, which have shown resilience amidst economic uncertainties. In Ontario, the industrial market remains robust, with significant demand for logistics and warehousing spaces, similar to trends observed in North American markets like Dallas and Chicago. This acquisition by S2 Capital underscores the cross-border relevance of industrial investments, as both Canadian and American markets are witnessing robust activity in this sector. An intriguing story is unfolding in Northern California, where a suburban outdoor mall is making a notable comeback. According to Rachel Shire from CoStar News, the ranch in Vacaville, California, formerly known as Alamo Plaza, is nearly fully leased. This transformation is part of a larger trend where aging suburban retail centers are being revitalized with new names and features. The Ranch, a 170,000 square foot shopping center located off the Interstate 80 freeway, has seen significant changes since its acquisition by San Francisco Bay Area-based FH1 Investments. The investment and management firm purchased the 1970s-era mall in the early 2000s when it was only around half leased. They embarked on a comprehensive update of the property to attract more tenants and turn it into a thriving retail hub. This move aligns with a broader trend of retailers moving away from traditional malls and gravitating towards suburban open-air shopping centers. These centers, particularly those anchored by grocery stores, have become increasingly attractive to investors. The flexible work schedules that have emerged since the COVID-19 pandemic have driven more traffic to neighborhood retail centers throughout the day, contributing to their rising occupancy rates. Notably, national floor coverings brand Floor & Decor has signed a 55,000 square foot lease at the ranch, bringing the retail property to 99% occupancy. Other new tenants include Body Rock, a Pilates studio, and Dog Stop, a premium dog grooming service, along with Round Table Pizza, Kitty Academy, Sky Zone Trampoline Park, and Journey Coffee. The renovations at the ranch have been extensive, adding new landscaping and pedestrian paths, play structures for kids, public restrooms, and refreshed outdoor dining areas. A 70-foot tower feature was also added to serve as a landmark, enhancing the center's appeal as a compelling destination for top-tier brands. This revitalization effort reflects the growing interest and investment in open-air retail centers across the United States. According to a report from Cohen & Steers, open-air shopping centers have become the most highly occupied of any major commercial property type in the United States. With low levels of new supply and renewed demand from businesses, these modest shopping centers are turning into attractive investment opportunities. In fact, at least $10 billion worth of U.S. open-air retail portfolios is expected to change hands in 2025, as reported by CBRE. The success of the ranch in Vacaville, California, underscores the potential for similar transformations in other suburban areas. By embracing the trend towards open-air centers and incorporating modern features, these properties can attract high-quality tenants and investors alike. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.